Have you ever wondered how a single metric like earnings per share or EPS can influence a company's stock price? If so, you're not alone. This question is at the heart of financial analysis and investment decision-making. To start with, let's unpack what earnings per share actually means. EPS is the portion of a company's profit allocated to each outstanding share of common stock. It's calculated by taking the net income of a company, subtracting any preferred dividends, and then dividing by the number of outstanding shares. So in essence, EPS is a measure of a company's profitability on a per-share basis. Why is this important, you might ask? Well, EPS is a vital tool in the investor's toolkit. It helps investors assess a company's profitability and compare it with other companies in the same industry. It's kind of like a report card for companies, showing how much profit they're making for their shareholders. Now let's talk about the connection between EPS and a company's stock price. One of the most direct applications of EPS is in the price to earnings, or PE ratio. This ratio is calculated by dividing the current stock price by the EPS. The PE ratio is a valuation ratio, meaning it helps investors determine if a stock is over or underpriced. A higher PE ratio might suggest that investors are expecting high future earnings growth and they are willing to pay more for each dollar of earnings. On the other hand, a lower PE ratio might indicate that the market has a less favorable outlook on the company's future earnings. EPS also plays a significant role in shaping investor perceptions. If a company consistently grows its EPS, it can signal to investors that the company is becoming more profitable, potentially driving the stock price up. Now that we know what EPS is, let's explore how it impacts a company's stock price. One of the most direct applications of EPS in evaluating a company's stock price is through the price-earnings or PE ratio. This ratio offers a snapshot of what the market is willing to pay for a company's earnings. It's calculated by taking the current stock price and dividing it by the EPS. Think of it as a price tag. Just as you'd look at the price of an item before purchasing, investors look at the PE ratio to determine if a stock's price is high or low relative to its earnings. A high PE ratio could suggest that the market has high expectations for a company's future earnings growth. Investors may be willing to pay a higher price today because they believe the company will earn more in the future. On the other hand, a low PE ratio might indicate that the market has less favorable expectations for the company's future earnings growth. It could also suggest that the stock is undervalued, meaning that it might be a good time to buy if you believe the market's expectations are too low. But here's where it gets interesting. The PE ratio isn't a standalone indicator. It's like a puzzle piece, providing part of the picture, but not the whole story. It's most useful when compared with the PE ratios of other companies in the same industry, or when compared with the market as a whole. This comparative analysis can give a sense of whether a particular company's stock is over or undervalued relative to its peers or the market. It's also worth remembering that the PE ratio is based on earnings, which are influenced by many factors including a company's operations, management decisions, and external economic conditions. Therefore, a high PE ratio doesn't always mean a stock is overvalued, nor does a low PE ratio necessarily mean a stock is a bargain. So a higher or lower PE can influence a company's stock price, but it's not the only factor. Let's see what else comes into play. Investor perception is a significant determinant of stock price, and earnings per share, or EPS, plays a substantial role in shaping this perception. Now let's consider how this unfolds in the real world of investing. When a company consistently grows its EPS, it is like a beacon attracting investors. The upward trend in EPS is often perceived positively, signaling a company's increasing profitability. This optimism can potentially drive the stock price up, as more investors want a piece of the profitable pie. But here's the twist. It's not always a solitary journey for a company's EPS. Investors often indulge in comparative analysis among peer companies. They juxtapose the EPS of different companies in the same industry, seeking the most profitable or efficiently managed ones. If a company's EPS towers over its competitors, it often steals the limelight. This could influence its stock price, pushing it higher than its peers. But remember, the stock market is not a one-size-fits-all arena. Different investors have different strategies, and some prefer a steady income over capital appreciation. This is where dividends come into play. Companies with a higher EPS have more profits to share with their shareholders. So, if a company decides to distribute a portion of its profits as dividends, it might make the stock more attractive to income-seeking investors. This could, in turn, impact the stock price. And then there's the fascinating world of stock buybacks. When a company uses its profits to buy back its own shares, it reduces the number of shares outstanding. This simple act can increase its EPS, as the same amount of profit is now spread over fewer shares. The improved earnings per remaining share and the increased demand for the shares in the market could potentially give the stock price a boost. EPS indeed influences investor perception. But what happens when a company decides to share its profits with shareholders or buy back its own shares? When a company makes a profit, it has two choices: reinvest in the business or distribute the profits as dividends. And this is where EPS, or earnings per share, comes into the picture. In the world of stock investing, companies with a higher EPS often have more profits available for distribution. They can use these profits to either reinvest in the business, fueling further growth, or distribute them as dividends to shareholders. This distribution of profits can make the company's stock more attractive to investors who are seeking regular income from their investments, which can potentially drive the stock price up. But it's not just about dividends. Companies can also use their profits to buy back their own shares from the market. This is known as a stock buyback or a share repurchase. When a company buys back its shares, it reduces the number of shares outstanding. This, in turn, increases its EPS because the same amount of profit is now distributed among fewer shares. Now you might be wondering, why would a company want to buy back its shares? Well, it's a strategic move. By reducing the number of shares outstanding, a company can make each remaining share more valuable. It's a way of returning money to shareholders without paying dividends. And there's another reason. When a company announces a stock buyback, it often signals to the market that the company believes its shares are undervalued. This can create a positive sentiment among investors, driving up the demand for the shares and potentially raising the stock price. But here's the catch. While a higher EPS can indicate a company's profitability, it doesn't always translate to a higher stock price. Remember, the stock market is influenced by a myriad of factors, including overall market conditions, investor sentiment, future growth prospects, industry performance, and the political and regulatory environment. So we see that EPS has multiple touch points with a company's stock price. But remember, it's not the only factor at play. While EPS is a significant player in the stock price game, it doesn't operate alone. Several other factors come into play. Firstly, market conditions are a major influence. These include overall economic indicators, market trends, and investor sentiment. For example, during an economic boom, investor optimism can drive up stock prices beyond what EPS might suggest. Conversely, in a downturn, even companies with robust EPS may see their stock prices fall due to pessimistic market sentiment. Next up, we have future growth prospects. Investors don't just look at a company's current performance, they're also interested in its potential for future growth. Companies that are expected to grow rapidly in the future may command higher stock prices, even if their current EPS is low. This is because investors are willing to pay a premium for potential future earnings. Now let's not forget industry performance. The performance, challenges, and opportunities in a company's industry sector significantly affect its stock price. For instance, if an industry is booming with innovation and growth, companies within that industry may see their stock prices rise, regardless of their individual EPS. On the flip side, if an industry is facing headwinds, companies within it may see their stock prices fall, regardless of their EPS. Finally, there's the political and regulatory environment. Changes in policies, regulations, or political stability can influence investment decisions, and thus stock prices. For example, a company operating in a politically unstable country or facing regulatory challenges may see its stock price negatively impacted, regardless of its EPS. In conclusion, while EPS is a critical piece of the puzzle, it's not the only piece. The stock market is a complex beast, influenced by a myriad of factors. So while EPS is undeniably tied to a company's stock price, it's essential to consider it as part of a broader analytical framework, encompassing various financial and non-financial factors. This comprehensive approach ensures a more holistic understanding of a company's value and the myriad factors influencing its stock price.